don't have the traditional slide deck. I haven't had a chance to put it together. I have everything. It's just going to be in a more raw form here.
No worries. I'm in Columbus, Ohio.
Yeah, that's right. You're in.
So
You're kind of my neck of the woods.
yeah, I went and set up the booth. We're here at the BC. Oop, there we go. BCMC show. Um, I'm. I love this show. It just amazes me the innovation. Like if you want to see the most innovative stuff in our industry, you come to this show. Um, I mean, all the big guys are here. 84 Lumber, Builders First Source, all the mills, like MyTech and Eagle Metals, and this is this is where
Yeah,
the
no, it's neat
innovation.
how they have all the displays set up where you can actually see kind of actual equipment and machinery. It's a pretty neat. It's not your traditional booth type setup.
No, by far, it's the noisiest show I've ever been to.
Right?
All right, that make it a little darker in here. That probably is better. All right, so what a turn of events we've had here since we last chatted.
Yeah, right.
Um,
Yeah, between the potential of a U.S. rail strike and then the Weyerhaeuser news today with the right to strike or a strike notice at up to 3 or 4 of their mills, there's never a dull moment. Just when you think if something can't jump up and surprise, lumber is the hold my beer market.
well, and then the big picture,
Yeah.
a massive um, inflation number today.
Yeah, and we can kind of start there. I've got that. Let me share. Are we live?
We are live.
Okay, let me share my. I gotta find the right screen. Hang on one second here. Okay, let's share. All right, I'm gonna do it this way so you can see that. Let me shut that down. You got pretty mountains. Let me drag stuff over here. So yeah, the actual, and I'm gonna
You gotta,
drag this in.
you gotta share the screen first there.
Oh, did I share? Okay, let's see. Let's go this one. Share. Okay, can you see that now?
Yeah, I just have to get my stuff out of the way.
And unfortunately, it's gonna be where I'm
Okay.
just gonna have to scroll through emails and all my rough data here. But you can see actual CPI was up 0.1%. Expectations were down 0.1%. CPI annual change was up 0.2%. Expectations were it was still down from July, but the expectations in that we would see a big decrease in this energy component, and even with the lower prices in unleaded gas, gasoline at the pump, food was a lot higher. So we still had the headline number in equities. We're anticipating, hey, we've done it. We've controlled inflation. We're going to start to moderate. And it was 180 degrees of those expectations. So equities, as a result, the Dow's down about 857, NASDAQ's down 526, S&P right now is down 125. And you've had some pretty big swings, reversals in the crude market. Gold's down $25. You're down just about everywhere except lumber and the grains. And I think lumber is the beneficiary of this potential rail strike and this Weyerhaeuser potential mill strike news with some of their U.S. mills. So,
But the other thing though in that CPI number was rents are going up.
yeah,
Um,
and here you go. Rents were up big. The blended, yeah, up dramatically. And I've got, and again, I apologize to everybody. And you as well, Mike. We're going to be jumping around from all over the place because I don't have this coordinated in a slide deck like I normally do. But
no worries.
let
Well,
me,
but think about the rents. If you put yourselves in the shoes of a developer or even someone who owns a rental property right now, your income is increasing. Now, your cost basis is probably increasing somewhat as well, but it just puts more money in your pocket to build more units. And rents go, when you have more money chasing less goods, that causes inflation. So we need more rental units, obviously.
Yeah, and so I've got a, let me just find this slide here. Where's it at here? Where's the pound? Yeah, here it is right here. So when you look at median monthly payments, so this is pretty obvious. Look at the disconnect between Q4, Q1 of 2021, where you almost had it was a no-brainer to go buy a house versus rent with low interest rates. Look at the average payment per month for a rental versus a mortgage payment, and then look at the disconnect as we've kind of got into Q4 a year ago, into Q4, into Q1, Q2. Well, okay, here's your mortgage payment. You're pricing people out of housing. So what do they have to do? They have to rent. So it's pretty obvious when you see this inflationary number when it comes to rent, where people are forced. It's not a question of, yeah, I want to rent. I can't afford to buy a house. I have to rent, and so landlords are taking full advantage of a hot market. And even though you've got inflation in rental payments, it's nowhere near the inflation we've seen, the appreciation we've seen in mortgage payments. So you push people into staying into rentals right now.
And there's no doubt it's the soup du jour, if you would. People want the flexibility. I mean, I think everything's just pointing towards more and more people wanting to rent.
Yeah, absolutely, absolutely. So I'm trying to think if there was anything. Again, CPI. This is the components of core inflation, and so okay, the one benefit here, used cars and trucks have come down, where you're probably kind of return to some kind of normalcy. But look at everything else, and boy, it's tough to see a light at the end of the tunnel where some of these things you're still not even done going up as far as the numbers are concerned. As much as we thought we'd see a moderation, a slowing of all these numbers building off of last month, no, some of these things still haven't reached their zenith yet, and that's kind of disconcerting. So the net takeaway with all this, if you're the Fed, guess what? Assets get tossed to the side. Your concern is inflation. So, I think it's a pretty safe assumption that after seeing this report, and we'll see what PPI shows tomorrow. But if I'm a betting man, the odds are going to go up. Instead of seeing a zero point 0.5 basis increase the end of this month with FOMC, you're going to see a 0.75 increase. And then thereafter, probably a zero point 0.5, where the earliest you would slow and reflect probably gets pushed back to November or December at this point, where until you get these numbers in consecutive months showing that inflation is under control outside of energy type at the pump type pricing, until you get consecutive months that show that the data that inflation is being contained, tamped down here, rates are going higher. And that's the Fed's mindset right now.
Um, and I was on the drive out here today listening to Bloomberg, and they were just talking about, while we're in our little bubble called the United States, the rest of the world is really feeling the pinch from the strong dollar on their inflation. So,
Yeah,
they have to raise their rates just to keep in check with the United States. Um,
and let me
and it's
find.
more likely that
Let's see.
the U.S. could push some of the other world economies into recession.
Absolutely. And so, here's a chart on the pound. And, we talked about the euro last week, how you were basically at parity, the first time in 20 some years. Well, the pound has retraced back to 1985 levels, or within striking distance of 1985 levels, where, just kind of look at the turn of events from 2020, 2021, where no, the mindset here, and I'll pull how do you control let me drag this one over. These are some of the charts that we look at on a weekly basis. Here's the chart that shows the US dollar versus other physical commodities. And so how do you control inflation? Well, the obvious answer is increase interest rates, but then the secondary answer is a strong US dollar policy where you want stuff denominated in US dollars. If the dollar appreciates, your cost of goods is cheaper, relatively speaking, on a global basis. So, how do you make yourself competitive? How do you bring down pricing, not only domestically, but globally? Well, you appreciate the dollar and you make your goods cheaper than anybody else's. And that's exactly why, for whatever, and you see this in crude where you get these kind of stair steps higher, sideways higher, and then you have these cathartic 1 day, 2 day events where crude gets annihilated by $5, $6 a thousand. Um, and as much as these markets are trying to bottom out, King Dollar here is very influential as far as the Fed is concerned and controlling or at least slowing any type of appreciation in physical commodities. And the reality is, you could say that, okay, there's the fear of slowing global demand, Chinese demand when it comes to oil. But the reality is that this is the secondary effect of what the Fed's trying to accomplish. Their fiscal policy, along with monetary policy, of higher interest rates and a higher U.S. dollar to control all type of physical commodities to get that net effect of seeing CPI, PPI come down at some point.
Well, and it's a conundrum. A strong dollar makes you want to import goods. And we've just proven that the supply chain can be very fragile and you want to domesticate your supply chain as much as possible. So it's,
Yeah, no, and that just takes time. I mean, you mentioned that you're in Columbus at the BCM MC show. So Columbus is going to be one of the big beneficiaries of the semiconductor intel, and I think the word on the street in Columbus, anyway, I've got a bunch of buddies down there, bankers, is that Intel will move their official corporate offices to Columbus, where a lot of some of the C-suite people already started to locate to Columbus in anticipation of building in the next 3 to 5 years. You're going to have two, I think it's something like a $10 billion plus type investment where they're building two massive semiconductor facilities in Columbus, and that's going to be the beneficiary of the federal chips program that's out there that was just passed. So the writing's on the wall that you domesticate all this stuff. It just takes time.
yeah, you can't,
Um,
a $10 billion plant doesn't pop up overnight, even if
no,
you build it with CLT.
yeah, exactly, exactly. So
All right.
here's the other chart, and we'll just look at rates. So what's the big byproduct of today? Well, we've gone back and retested the recent lows in the 10-year. So whatever kind of, again, we made this attempt, rates have kind of paused for the time being. Well, you're right back at it as far as interest rates are concerned, where the 10-year, 30-year treasury, 30-year mortgage rates are back at those recent all-time highs. So again, don't fight the Fed, and the Fed's telling you numero uno is inflation, and we're raising rates, and we're going to positively appreciate our dollar to combat that. That's what the Fed's telling you. So um, let me see what else I wanted to. We'll run through before we get into lumber, and I know there's a lot going on in lumber. I just wanted to show a couple of these other charts. I thought this was as far as trying to extrapolate what demand looks like, um, uh, um, I think this is all telling, and this is from John Burns, Real Estate again. Builders' current market conditions. These are all the publicly traded home builders. Look at where they were a year ago. This is interest in buying homes. Basically like a builder sentiment with actual walkthrough business lined up a year ago. Look at all the big KMB homes, NVR, Toll Brothers, Lennar. They're all here. Look at a year ago versus today. If this isn't all telling, the idea that demand is going to be a savior when it comes to housing is highly unlikely. And you're seeing that from the home builders. And then the other one that I thought, here's Burns Home Value Index of Appreciation. And you can see how you're getting at least topping out in all of these hot markets and a significant rollover in some of these more obvious markets where, look at South Florida, North Florida, the Southeast, look at Texas, the Southwest. At the very least, you've had this rolling over, in even the hottest areas are no longer seeing home price appreciation. Uh,
It's you make it more expensive to buy a house. It's going to slow it
yeah,
down.
and then there was one other one, and then we'll kind of um, here's construction costs have grown faster than home prices now in the last four of the last 6 quarters. Again, that becomes all telling. The other one that I thought was just an awesome chart here. Let's see here. Let me just find, and I apologize for having to do this. So net income of the 7 largest home builders rose more than 150% in the last 2 years. They pay down their debt to probably the lowest levels in history. This gives them a fortress-like balance sheet. So you look at pre-tax net income, they're sitting on their cash coffers. You look at debt, lowest historical debt on record. So this kind of, there was one chart here. Let me see if I can find this. Where is it at? We'll come back to that nat gas and then we'll jump into housing. But there's just one other chart I wanted to show here with all of this, and I just have to.
Speaking of that, it's I know where you're going with this, and it's kind of been in the back of my mind as well. Um, Previously, when markets slowed, especially sawmills they would run just for cash flow because they had to service debt. With the amount of money that they made and their balance sheets begin getting cleaned up and becoming smaller and smaller, or their debt load becoming smaller and smaller, it's going to allow them to right size to the market more quickly.
Yeah, yeah.
Um,
No, there was one
so
chart that just
I think
showed home builders' ability to incentivize how they can lower their prices, and incentivize people to buy homes. That's the one positive aspect of all of this with building out their cash reserves, is that they can further incentivize people, if they so choose, as far as trying to find people that are on the fence with buying homes. I wish it's somewhere here, but I'm not gonna. We've dicked around long enough here. So the other chart that I wanted to show, and I know we talked about this last week, and I found something visually. Here's natural gas prices in the U.S.
oh geez, what a
versus
nightmare.
UK versus the EU. And yeah, you've come off dramatically off the highs in the UK and the EU, but just look at the differential in that what we think we're going to have to pay is high this winter, and we've seen a massive bump up in prices being at $2.50 to, I know in Ohio here we're probably up at around $6.50 if you wanted to lock in rates right now. Just look at that differential for, what's the best case scenario here versus look at where you were a year ago in the UK and the EU. The idea where you would have to collapse back to just to be where you were a year ago, let alone kind of historical type levels. So the idea that there's going to be, and this kind of kind of works back into global FX rates. There's a lot of pressure on the EU. There's a lot of pressure in the UK. You know, pick a European country, and how do you sell this to your constituency? You're going to annihilate people, and God forbid you have a colder than expected winter. Look at these prices, people. How much of this can you subsidize? So again, this just becomes the idea that the EU, the UK can avoid a recession. There's a lot of things that are going to happen from an inflationary standpoint to justify this. So the idea that our strong dollar policy, again, to satisfy our what we need to do here, is definitely having a very negative consequence in Europe right now.
Yeah.
above and beyond just Russia, the UK, Ukraine, Ukraine, and all that good stuff. But let's jump into
Lumber.
lumber, and let me pull up. Let's see here. Let's start with. Um, so obviously the big news week over week in lumber right now is the potential for a U.S. rail strike. I know the CN, the BNSF have kind of put out embargo notices, proactively, preemptively in anticipation of a strike, where there's the idea that you're going to have essential, non-essential type items. Obviously, grains, energies would be deemed essential. Lumber is non-essential. So the CN is reacting in accordance with telling people. I know one of the big mills today, there's questions whether West Fraser could even ship rail cars into the U.S. today. Look, the reality with the strike is it's probably buy the rumor, sell the fact. But for an industry that's had supply chains the entire year, logistical issues the entire year with rail, this certainly gives the mills the ability to take cut out. My back, Mike? I think it.
Yep, you're
Okay.
here.
This gives mills full advantage to try to build an order file. And when you look at kind of a September chart here, um, this is, let me go back to, back to this. Let's go back. I'm going to look at November here, more so than September. I just want to show kind of what we've done. Just in the last 6 trading days, the market made a low in November at 456. And without any real appreciable change in physical cash, we probably affirmed from 480 into the 510-ish type area right now. I think mills legitimately are. Um, so I was going to say is that you've had a nice move higher in November here, where November's gotten up to the 576.70 area today. So you've had a pretty substantial increase off the lows in November, January, and September. Is this going to be catalyst? And we'll look at, and everybody's kind of intrigued here. Well, what's best case scenario? So, you're up into the Bollinger Band high, you're up into the 50-day moving average. You're up
Is
in,
that noise coming through?
yeah, yeah.
My internet is bouncing here. So
Yeah, no, all good, all good. But so best case scenario where we could get back to would be the 600 to 630 area technically. And the big question is, do the funds get pushed out of their position? And I'll kind of bring this into the answer is probably not. I think unless there's some kind of fundamental change when it comes to the structure of housing or lumber. And after seeing CPI today, I think it's very difficult to say that you're just going to blindly push the funds out of their position. So when you look at managed money positions, they're still increased as of last week. I guess the one positive thing here is that you started to see some managed money come in. But the thing that really, this has been the known all along. The thing that scares me to death with this, and this becomes the hope at higher strategy. So sawmills, if you're listening, this is your opportunity in the hopes that you push these guys to the sideline. Look at producer shorts, 114.
it's unbelievable.
Look at other reportable shorts, 2. The industry is not short this market. So when you see from a basis standpoint, the basis structure go from a massive discount in futures relative to cash to a premium, again, producers take notes. This is your chance to sell at a premium to where you're selling physical cash, especially into the time frame where November is the weakest contract month out of the year. The seasonal lows likely are still ahead of you. Whether you have to make new lower lows in physical cash or futures, I guess that's debatable. But what's the upside potential here if you're a producer versus the downside risk? And we've talked about this since May expiration, since July expiration, where managed money is playing with house money right now. They've been short the last $300 to $400 a thousand. Best case scenario, if you're a producer, is somehow you magically force these guys out on this strength, and you see the producer side replace these guys. But again, structurally, does it make sense for lumber to rally up here? Are the mills going to still curtail if prices reset at $600 a thousand? Do you still see curtailments that come out of either North American production? So just the idea that I know we bottomed out last year and we had a sizable rally thereafter, but just ask yourself structurally, is this year different than last year? And you're going to be hard pressed to find anybody that thinks structurally demand can be the savior moving forward to justify higher numbers. This is your chance if you're a producer to capture. And I'll jump. Let me jump back here.
I look at that structure there, and if you think you're the only one on the sideline getting ready to sell,
Yeah.
uh, sorry, there's a few guys standing right
Yeah,
next to
no,
you.
no, exactly. I think that's spot on. And, we'll look at so here's basis. I wish I could shrink this a little bit, but you can see how we were at even money. Now we're starting to see the structure of futures go to a premium to cash. And so when you look at, basically a week ago, this November was, within $10-15. It's out to 53.80 as of this morning. September was even money. It's out to $45. If I'm a sawmill here and I can sell 510 in September, or I could sell 550, we just got out to 562 plus. You're selling the same wood. Why is a sawmill on at 510 right now and not selling futures at 560?
That is a really good
Yeah,
question.
if I'm a shareholder, I might be asking them that question right now.
But the last 2 days we've seen some solid volume. I mean, in November, 500 and some
Yeah,
yesterday, and
yeah, no,
we
and
got over
and that's
1,000.
again, you did get some light. We'll pull up. One second here. We'll pull up. Yeah. So yesterday's limit up move. You did get some liquidation in November, down 112. September, my guess is there were 12 EFPs. We're up over probably 20, 25 EFPs. When I look at this open interest, probably 100 of these can be accounted for with additional EFPs. And I think the higher we go, the more incentivized certain sawmills that actually use futures will be to capture that premium versus where they're selling physical cash. But okay, you're starting to see minor liquidation in November. You're gonna wash out some of the weak-handed shorts here, but that meat of that fund position, I don't think is going anywhere. I think they're entrenched in that position. And again, best case scenario, the hope strategy is somehow something structurally forces them out. Margin calls, they see something, read something differently. But when you see the CPI number, you see the idea that interest rates are not going to moderate, they're likely to go higher. It becomes very difficult for me to suggest to anybody that, yeah, let's hope that the funds get out so you can sell higher numbers.
Yeah, the macro trend is hold your position.
Yeah, no, the macro trend is hold your position. And when you look at this, I'd love to tell you to wait to 630 or magically tell you to wait to 700. Look, that would be a phenomenal scenario if you could convince me that the funds, or something that the funds are going to liquidate. You certainly could get a much bigger severe rally to the upside. But just bear in mind that when you go back and look at those CFTC numbers, close that out, sorry. When you go back and look at those CFTC numbers, the hope is that somehow these shorts get pushed out and get transferred here. And that's, I would be highly skeptical, especially on the reasoning, the rationale behind why we're rallying. The hope is still higher. The hope is not lower at this point.
And if you just go back to that November chart, we can talk about the technical analysis on it.
Yeah, let me
It
pull it up here.
it's still a downtrend,
Yeah, yeah,
long term.
yeah.
That is a downtrend still. Now, I would be a little suspect because of this significant pullback, but if we stall out and don't take that high out, it's still a
Yeah, and
downtrend.
so look, here's the weekly, and again, the weekly is still a reflection of September. When September goes off, then you'll get the reflection of November. So we're trying to break out to the upside. Again, somehow, if you could break out to the upside, maybe you trade up to the 600 to 630 area. But the reality is, you probably would have an easier time doing it in September, squeezing bad shorts out of the market than you would in November. And even if you could do that, then the idea that you're going to somehow break through this area and get this massive fund short covering the funds to go long and get a breakout in physical cash. Again, to me, that's the hope strategy. Does the industry want this market going here, or does the industry want the market to trade back to the lows? If you ask the producers, you know what the answer is. Uh, uh,
Yeah, I think right now this is a tough market, straight up tough market. So many outside influences that can change overnight. The strike thing, the balance sheet on you know the mills, and then the overall economy. Where do you hang your hat? Which fact do you put your money to work
Yeah,
on?
no,
Um,
absolutely. And so the other part of this is we talked about spreads a week ago, Mike. A week ago, that spread, SEP Nove still had a carry structure to it where SEP was trading 20, 25 over. You finally had the collapse into inversion where at the low water market yesterday on the open, it traded 30 under. It's kind of floating around right now. When I go back and look at the Nove. Let me pull up Nove Jan here. Hang on one second here. When I look at the Nove Jan, yeah, here we go. Like this is the other one where um, a week ago this Nove Jan spread was trading 20 under, 15 under. It's come into negative 860. So, this is the other way to get short where seasonally does it make sense for Nov Jan to go to a premium, to go to a carry structure? The answer is no. The reality is that if there's a weak spread structure, it's probably the Nov Jan. So I'd be careful chasing strength here. The reality is this spread can easily go back to 20 to 25 under. So these are the things that, is there justification for what's going on? And, we know why we're rallying. We know, I guess, technically why we could rally further. But at the end of the day, there better be some kind of structural, fundamental reason to support all of this market moving higher. And this is where I like to beat this into people's heads all the time. I know Alex at Stone does the same thing. The concept of basis, cash minus futures. Why do you have the structure? And in a bear market structure, you're at least getting the justification where you're getting futures trading at a premium. So understand, does futures belong at a premium to physical cash? There better be some important structural fundamental reasons why to justify that. If the answer is no, then you can get a reversion to where you were a week ago pretty quickly.
so my big takeaway right now is we may be trendless. We might be going sharply sideways, and those are really tough markets.
Yeah, yeah. And again, Tim Hansen asks, knowing that nobody thinks the rail strike will stick, do you think this rally is largely due to the fear of a rail strike? I think absolutely. I think this is buy your rumor and then potentially sell the fact. Again, unless there's some kind of fundamental justification where you can show you're permanently going to disrupt supply and re-engage the demand component. This is your classic short covering rally in physical cash. But the idea that people are going to build out inventory at these levels, I think is going to be easier said than done to justify that, especially going back to all the headwinds we just discussed in every other market where it's going to be tough. It's going to be tough to justify the idea that we've turned the corner with housing and that lower lows and weaker housing numbers are ahead of us. They're not behind us.
True. All right, Greg, thank you very much. Look forward to seeing you tomorrow, right?
Yeah,
You're going to be down here?
absolutely. We'll definitely hook up. If you're in Columbus for the show, by all means reach out and we can get a cup of coffee or maybe something else. But we'll see you soon, and I appreciate the time.
Yeah, for sure. If you're down here in Columbus, come by the Materials Exchange booth. We're going to be in the National Framers Summit and, of course, in the BCMC show. Would love to tell you more about our platform, and we can grab Greg Kuda. He can come by and
Yeah,
say
and
hello
the
to you
other
as well.
thing, anybody that's going to be at that show, Allie Wolf is speaking from Zonda, and I think she's one of the truly phenomenal people in this industry on the cutting edge of kind of reading the pulse of housing. So it'll be interesting to hear her commentary as well on the state of housing and what likely lies ahead, because I think she's been pretty impactful as far as being able to read all this in real time.
Perfect. All right, everyone, we're checking out, and we'll catch up with you next Tuesday.
Thanks a lot, Mike. Talk to you soon.